The work didn't change. The skill didn't change, but the pay, well, it did. Have you ever noticed something about wages in different parts of the country? Some places the trades pay really well, strong wages, good benefits, a clear path to solid middle-class life. And in other places, the work looks exactly the same, but the pay, well, it just isn't there. Same skill, same job, very different paycheck. That doesn't happen by accident, because in every industry there are standards that help determine what skilled work is worth. And when those standards start losing their influence, the entire market can start sliding. That's when working families start feeling the pressure. And if you've seen wages go down while the work stays the same, make sure to like and share this video so more people hear about blue-collar issues. Today on Labor Lines, we're talking about wage floors and how they affect the whole industry. And you know what? It's that time. Let's get into it. Last week, we talked about prevailing wage and how public construction projects help set the wage standards in a region. But that conversation, well, it leads to a bigger question. What happens when the wage standards that once helped set the market stop doing that? That's where the idea of wage floor comes in. A wage floor is basically the baseline pay for a type of work in a region, or the going rate. In construction, that might be the average pay for a journeyman electrician, a laborer, or carpenter. Historically, a lot of those wage floors were influenced by union contracts. Even non-union contractors often followed those standards because they still had to compete for the same skilled workers. That's why prevailing wage laws and union wage standards often work together. They help stabilize the market for skilled labor. And this isn't just a union issue. For years, non-union workers have been told unions hurt them. But the reality is, strong wage standards tend to lift the market for everyone. Because when contractors compete for skilled workers, wages tend to rise, and that's just basic math. When workers compete against each other instead, wages tend to fall. Again, basic math. Now, this is where right to work enters the conversation. Right-to-work laws allow workers covered by union contracts to opt out of paying union dues while still receiving the benefit of that contract. I've said this before, hell, I've made a whole video about it, but right-to-work doesn't give you any newfound rights. It doesn't force you to do anything. It allows you to join a club and benefit from the membership without having to pay to be a member. Period. Supporters frame that as worker freedom. But the real effect is that it weakens the funding structure behind collective bargaining. And when collective bargaining weakens, something important starts to happen. Union wages themselves don't suddenly collapse. Those wages are negotiated under a contract and will be the same until that contract is renegotiated. What changes is market share. Fewer contractors operate under union agreements. And when fewer companies are competing against those higher standards, the wage floor starts losing its influence over the broader market. That's when the market begins to shift. Not because the work changed, not because the skill changed, but because the standard that helped set the value of that work is no longer setting the market. Now, supporters of right to work often make a different argument. They say it brings new business and jobs. And to be fair, they're not completely wrong. Some companies absolutely do move into right-to-work states. But the real question isn't whether jobs come, the real question is what kind of jobs are they? Because not all job growth is the same. Supporters of right-to-work often point to economic development announcements and job creation numbers in those states. And again, to be fair, sometimes companies do move to places where labor costs are lower. But when researchers look more closely at the data, a different picture starts to appear. In many right-to-work states, a large share of job growth happens in sectors like retail, hospitality, logistics, and other service industries. Jobs that tend to pay lower wages on average. Research from the Economic Policy Institute shows that after adjusting for cost of living, workers in right-to-work states earn about 3% less on average. And that might not sound dramatic, but if you have a $50,000 salary, that's about $1,500 less every year. Across an entire state economy, that adds up to billions in lost wages. And if you've noticed by now, all of this really comes back to the same theme. Union or non-union, different policies, different arguments, but the outcome often looks the same. Somebody's making more money, and it usually isn't the workers. What we keep seeing is the people at the top using the working class to pad their bank accounts. When wage standards weaken, more of the value workers create starts moving upward instead of staying in their paychecks. And this matters even more right now because everything in life is getting more expensive. Gas, groceries, housing, insurance, doctor bills. The cost of living keeps going up. So why should the value of your work go down? Why should the only thing in the economy moving backwards be your paycheck? That's the real question behind this conversation. Because wage standards don't just affect union workers. They shape the entire market. And when those standards stop setting the market, workers are the ones who feel it first. So here's the real question. What would it mean for you and your family if the wages in your trades started to decline? If the standard that helped determine what your work was worth slowly disappeared? That's the impact we're really talking about. If this is something that matters to you, make sure to like, follow, and share so more people can be a part of the conversation. Because working families across this country are facing real pressure. And the only way that changes is when people start speaking up. Make sure to tune in this Sunday where we'll once again give our respect to women in the trades for my addition to Women's History Month. You don't want to miss it. And remember, we learn best by shared experience, so keep those comments coming. This is Labor Lines with Alex. As always, my good friends, be safe, be productive, be well.